Hi, my name is Neal Chen,
And I'm Nick Ong.
and we are from BASIS Chandler.
And today we're going to be presenting our buy recommendation for Grab Holdings Limited. Our target price is $6.38, and this represents a 45% upside. So what even is Grab? Grab is a super app, meaning that it combines multiple apps into one. It provides 3 services for everyday customers, and that is the food delivery services, ride-hailing services, and fintech services. You can think of it as the Uber, DoorDash, and PayPal, except for Southeast Asia. It was founded in 2012 by Anthony Tan, which is considered rather recent as this was before Southeast Asia's digital economy really took off. Its mobility and delivery services are considered the most mature and stable sources of revenue, whereas the new fintech sector is rather experimental.
We based our investment on 3 main factors. The first is its moderate but expanding economic moat. Grab has already established local dominance. For example, 70% of the ride-hailing market share in Southeast Asia. This positions themselves for greater monetization opportunities such as financial services, which have structurally higher margins that increase revenue and reinforce that economic moat. Secondly, there is also its unique multi-sided platform, which connects many users, like riders to drivers and consumers to merchants, which brings more value to the platform as more people use it. For example, the more riders there are, increases the demand for drivers, and the more drivers leads to increased availability and more convenience, which in turn will attract more customers. This natural system of bringing in more customers will decrease acquisition costs.
And the third and final reason is its alignment with economic trends. Southeast Asia as an emerging market has seen very recent and very explosive market growth, which will in turn increase income. This rise in discretionary income will then increase the demand for Grab services. Furthermore, mobile phone penetration rates in Southeast Asia have been consistently on the rise. Since Grab relies on its digital platform and digital economy, this will increase access to Grab services and massively increase its potential customer base. So here's our industry overview. Grab currently dominates Southeast Asia's digital economy and has a very strong market positioning across all of the segments that it competes in. For ride-hailing, Grab holds a crushing 70% of the market share for Southeast Asia, which is significantly ahead of all of its competitors. For food delivery, while not as dominant, it still holds the majority market share. Both of these industries have demonstrated consistent growth over time and have made up the backbone for Grab's revenue ever since its founding.
For fintech, Grab is a top digital wallet in the area. Despite not playing a very large role right now, in the future, because of its higher margins, it will play a greater impact and increase profits. And for the Porter's 5 forces, the threat of new entrants is very low. This is because Grab already benefits from massive network effects and scale advantages. Furthermore, high regulatory barriers like permits and licenses protect incumbents like Grab. And finally, capital intensity and low initial margins will deter new entrants because of low profitability in the early stages.
For the power of suppliers, it is moderate right now, but it will only decrease over time. Drivers and merchants can use multiple platforms. However, because of Grab's massive demand base, this will decrease any meaningful supplier switching. For the power of buyers, it is extremely high right now, and consumers are very price sensitive and promotion driven. Because there are no costs for switching between apps, consumers will adopt whichever app is the cheapest. However, Grab's network effects make it the most convenient app to use.
The threat of substitutes is also very low because for ride-hailing, public transit is very limited and underdeveloped in many markets. For delivery, although dine-in exists, most people prefer food delivery because it's more convenient. And finally, for fintech, although cash still exists, urbanization favors digital payments like GrabPay. And finally, competitive rivalry, which is the highest risk here because of strong competition from local platforms, which leads to price competition and incentives that pressure margins. There are 3 key revenue drivers for Grab. The first one is rising user frequency and engagement. Monthly transacting users rise as Grab embeds itself into daily life. And multi-service users spend 2.5 times more than single-service users. For example, a user doing ride-hailing with Grab is more likely to do Grab Pay as well, increasing the spending on the platform. And Grab Unlimited subscriptions also boost order frequency by 30% without any new users.
The second main revenue driver is declining incentives and increasing take rates. This ties back to Porter's 5 forces. As the power of surprise decreases, then the margins for Grab will increase. Higher take rates increase revenue per transaction, even as GMV stays constant. The third and most important revenue driver is the expansion of Southeast Asia's digital economy. This has already exceeded $300 billion. Also, the rapid shift towards cashless payments and mobile banking places Grab's fintech sector, Grab Pay, in a favorable position.
And for the financial analysis, Grab has recently reached a profitability inflection point, reaching profitability for the first time in Q3 of 2025, and it's been profitable ever since, signaling a shift in mindset of growth at all costs to sustained profitability. Its free cash flow is expected to grow at 29% from 2025 to 2028, which is based off a declining growth rate model as the market matures.
For our price valuation, we used a sum of the parts approach, or SOTP. This allows us to reflect the diversity across Grab's different sectors. For the mobility and delivery sectors, we used an EBITDA to EV multiple, as these are the most mature sectors of Grab. For the financial services, we used a DCF, as this allows us to reflect the future potential that this has. Finally, for AI optimizations, we added a small premium. As demonstrated on the graph, in the near future, we expect the fintech sector of Grab to be just as valuable as its delivery sector.
There are 3 main investment risks. The first is competition, which has already been mentioned in Porter's. But intense competition and low switching costs require continued investment and incentives to defend market share. However, this can be mitigated through strong network effects and controlled incentive targeting towards those most likely to spend the most amount of money. The second is a regulatory risk. Things like commission caps in key markets and the burden of regulatory compliance increases operational costs. However, this can be mitigated through reducing reliance on commissions and diversifying monetization through things like financial services. Finally, phased entry through partnerships share the burden of regulatory compliance, like when Grab partnered with Singtel to form GXS Bank in a highly regulated sector.
The third investment risk is economic vulnerability. As an emerging market, Southeast Asia will always have some inherent risk. After all, this is a very high risk and high reward situation. This was seen in the 1997 Asian financial crisis. However, these can be mitigated in 2 ways. The first is to focus on inelastic necessities such as grocery delivery services. After all, these would always be in high demand regardless of the economic situation. The second is using a variable cost structure. This would allow Grab to easily scale back and cut costs during economic downturns.
Grab is strongly committed to ESG. For its environment, it has an ambitious goal of reaching carbon neutral by 2040, and it also has many EV partnerships with GMC and BYD. It also focuses on plastic waste reduction as well. For social, it focuses on disaster relief, and it also has an education fund, Grab Scholar, for college students. Finally, it has a strong independent board and an MSCI AA rating, which demonstrates they are leaders in ESG.
For AI's impact on Grab, it would have a rather strictly positive impact. This is best seen in 3 ways. The first is delivery route optimization. Similar to programs incorporated by Uber or DoorDash, dynamic routing initiatives will boost efficiency. The second is AI fraud detection, which will enhance security that's necessary for GrabPay's future scaling. The final way is support and onboarding automation, which would help increase merchant verification efficiency and also decrease customer service costs. So in conclusion, you should buy Grab because of its rapidly expanding economic moat, its network effects, and its benefit from Southeast Asia's growing trends, as well as the shift in its mindset from growth at all costs to stable profitability.
Thank you.